Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. The Rajya Sabha votes to divide Jammu and Kashmir into two union territories and revoke Article 370, giving special status to the state. The US has formally labeled China a currency manipulator after the People's Bank of China let the yuan slip below the $7 per dollar mark. The Dow Jones falls over 700 points, clocking the worst day of 2019. And Asian markets see sharp cuts on open as the trade war escalates. The rupee clocked its biggest one-day fall in over 6 years yesterday, dragged by a mix of weak local and global cues. And frankly, that's the moot point, really, what's happening in the world. And the trade war intensification is leading to the issues at hand for world markets. Now remember, on a normal course, and I still firmly believe that's the case, in normal parlance, the trade war escalation may have had a particular kind of impact on the equity markets, but the fact that the PBOC has done what it has done really impacts the currency markets in a big way, and I think that's what we should try and focus on today, start off the show, before we get into the trade setup as well. So let's start with that escalating trade war. Remember, what the Trump administration has done is formally labeled China a currency manipulator after the PBOC let the yuan slip below the $7 per dollar mark in retaliation to the tariffs. The tensions have taken a toll on the US Treasury yields as well. The 10-year yield went below the 1.74 mark, further deepening the yield curve and the difference between the 3-month and the 10-year as well, which is arguably to a lot of people's mind, a warning of an upcoming recession. To talk about the implications of the currency and the bond markets first, we're joined on the show by Peter Cardio. He's the chief market economist at Spartan Capital Securities from New York. Peter, good morning, or rather good evening to you. Thanks for taking the time out. It's been a rough day in the US. I'm sure you're glad it's over. But what are the implications of all that's happened in the last 24 hours for the yields and for the currencies?
Well, there's no question, that the trade war has now expanded. Obviously, President Trump has decided to take the trade war to new heights, and of course, we saw the consequences of this because China retaliated and basically devalued its currency, and it now appears that we'll be fighting not only a trade war, but a foreign exchange war as well, currency war, that is. And so it comes down to one thing, that this trade war is going to have a negative impact on the economy and the global economy as well. And so there are other factors, perhaps also, that are involved, and that is this is the way the President of the United States is muddling into the Federal Reserve and is probably going to force them to lower interest rates. Sure. So that he can continue with this trade war, or at least have less negative impact in terms of the economy.
Yeah, Peter. Peter, if I may, the larger perspective for a lot of our Indian audience would be that how strongly do you read this whole drop in the yields and this inversion that the 3-month versus the 10-year is showing? I mean, the previous indicators of a recession haven't quite reached there. Yeah. Do you think this time around could be different?
I think if the trade war continues for another couple of months, there's no doubt that we're going to slip towards negative economic activity. If you look at the yield curve, that's what's indicating right now. And so what I'm hoping for is, and I think that, somewhere in the near future, when I say the near future, I'm talking about maybe sometime in September, October, that we can see some real progress between China and the United States, and hopefully that Trump will be able to move backwards on the new 10% proposed tariffs, which he intends to slap on beginning September the 1st. I think if he does that, then that could alleviate a lot of the problems and probably, even alleviate an expansion of a currency war. But, of course, we'll just wait and see what the future holds. But right now it's about the trade war, about the currency war, and investors are playing it very, very cautious and retreating from the stock market.
Well, as they probably should as well, most people would say. Peter Carrier, thank you so much for staying up for us and giving us your thoughts on what the money markets are saying. But remember, as we said, the pain doesn't end with the money markets. The global equity markets, the Dow Jones fell over 700 points in trade last night, making it the worst day in 2019 for the US markets. And Asia too is open with sharp cuts. Joining us now is Jeffrey Dennis, independent emerging market commentator all the way from California. Jeff, good morning or good evening to you. Thanks so much for staying up for us. I think the previous commentator made this point that because it's now also a currency war and not just a trade war, people might be taking a step back. My question to you is, how worse can it get?
That's a very tough call to make. I think in terms of the currency war side of things, it can get quite a bit worse, because what the U.S. government is doing, what the White House is doing, is increasingly lashing out at a number of countries which have weak currencies against the dollar. And to the extent that the stronger dollar is a negative, a marginal negative for growth in the U.S., it's obviously encouraging the White House to put pressure on the Fed to reduce interest rates. So I think that I think the fact that you saw this move by the Chinese on Monday, and although the fixing was perhaps a little stronger than people thought today, nonetheless it's gone through 7. The market rate here on the currency means this currency war can go further. Now, as to what will happen with the tariffs, that's of course very, very hard to believe. But the point about the post I put up today is that if anyone had said to us 18 months ago that we had tariffs on, or we're going to have tariffs on every import from China into the U.S., tit-for-tat tariffs from China on the U.S., and currency weakening by the Chinese and being named as a currency manipulator, I think we'd all think there was going to be a recession anyway. So I think the issue now is not does it get worse, what it means for the global economy, what it means for the U.S. economy, because there are disturbing, echoes here of the 1930s. It's exactly what happened in the 1930s, and that was the point of the post that I put up today.
Now, Jeffrey, my question to you, therefore, would be, of course, China is now trying to rough up Trump in the area where it hurts the most, right? Agri-produce, farmers, the biggest voter base, and try to hit him there where it hurts. My question is, going into 2020, Trump would want to enter into that election season with the Dow not at 25, but at 30,000, right? Can he afford to take this up further than where it is right now? And is there some room left for both sides to have a face-saving maneuver backwards, because it is in their interest that it happens?
Oh, absolutely. There's room for them to have a face-saving solution and to get an agreement which takes these tariffs off. So often we get back to business as usual, if you like. But frankly, there's been not much logic to what he's done so far anyway. So the whole idea that, he's now going to suddenly be able to look ahead and say, oh, we've got an election coming up in 15 months' time, and I better, not turn any more aggressive on this because it might risk a recession. I think we can all see this in the market. Hopefully somebody's telling them this in the White House. But right now, this thing has already gone so much further than had been anticipated that it's got to make people believe that, he's not worrying about the economy in 2020. Now, as I say, there's plenty of room for a face-saving agreement. But I think what's happening now is the Chinese are once again showing that they're not going to be pushed around by the U.S.
Yeah, well, certainly.
And at some point, there is the possibility there for the U.S. will back down.
Certainly. Jeffrey, one last question really. In light of this, what do you do? I mean, equities are taking a rough ride. Maybe the bond markets are a safe haven of sorts in the US and the rest of the world too. Gold has shown that uptick as well. Where do you park money if you do, or would you rather sit on cash for the time being?
Well, I think you've got to see how this thing plays out. I mean, clearly what the bond market is doing, and your previous commentator made that point, clearly what the bond market is doing in the inversion of the yield curve is telling you is that there may well be a recession coming. So, and I tend to believe there's a pretty good chance there will be a recession by election time in the U.S. So I think it's very hard to just say, you look at this equity market now and you just back up the truck. I think you've got to see how this all plays out. Although I would hope and believe there's a decent chance that good sense will prevail, but I would certainly not be necessarily diving back into it immediately. You've got to see how the trade war in particular plays itself out, while watching, of course, the threat of recession, which means watching the shape of the yield curve, watching the U.S. bond market.
Okay, Jeffrey, we'll leave it at that. Thank you so much for taking the time out and speaking to us here at Bloomberg Quint. Well, that's the view from Jeffrey Dennis, independent market commentator and a veteran in the U.S. markets and the world markets at that. I mean, in fact, used to look at emerging markets very, very closely. Well, certainly seems to be that safe haven is the place to be, and it's evident in the way the U.S. bond markets have done, in the way gold has done. And mind you, the currency depreciation in India has that enhanced impact on gold prices back home in India. But gold prices have certainly shot up. So shining bright is the yellow metal. That has some wealth effect impact for India. But trust me, right now, nobody's thinking about that. The falling equity markets are the pain point for almost everybody. Just a quick look at the trade setup for the day before we move on. So, our markets, it's just not plausible to think of a rebound because we may be oversold, we may be near some key Fibonacci retracement levels, etc., etc. But the absence of global pain may have helped rebound from the oversold zone, but we don't have that absence, and therefore it's very difficult to see a positive up move amidst the weak global market scenario. And the FI outflows only, add more fuel to the fire. Look at those numbers. When you have such large outflows happening from FI side, and that would be the top 100 stocks, I would reckon it's very difficult for the headline numbers to bounce back, even if the DIs were to go out and buy. So please be wary, and if you're trading out for an up move, it may well happen, but seems unlikely. Very, very important to also monitor what happens in terms of fundamental news flow back home as well. And we'll talk about the Jammu and Kashmir situation in a bit, but just a very brief point on what the results are slated to come out today. Indiabulls Housing Finance for Titan, and Titan would be a very important barometer of how that company is shaping up. Some numbers are already out, but interesting to see what they're doing in terms of margins. Some key mid-cap numbers, the likes of Pidilite, JK Lakshmi Cement as well. And a few stocks to monitor on open today. Berger Paints, I think the numbers were very good. Double-digit volume growth and the lower crude prices and raw material cost aided the margins for Berger. So watch out for this one. Watch out for SRF. The results met estimates, but by and large, specialty chemical companies are not quite reacting to good results as well. Maybe SRF won't either. Strong results from Torrent Power, Mangalam Cement and PNB Gills. Both Mangalam and PNB returned to a profit from a loss. Let's wait and watch if these stocks react. Last but not the least, Bharat Forge, the Class 8 truck sales fell 80% YOY, 22% month on month. From ACT Research that we've got on this data is the lowest number since February 2010. Maybe these stocks would correct further. And maybe Ujjivan, wherein price targets have been cut even further because the holding company discount has been increased, at least by Macquarie. So do watch out for this stock. Was under pain yesterday, even Equitas was. Maybe they will react further. Let's tell you what's lined up on First Word today. A collection of the top editorial stories. One of Shapoorji Pallonji's flagship companies is coming out with the largest primary equity offering thus far in 2019. Somit takes us through the details. Agam tells us why the first quarter numbers have left consumer companies high and dry. And we speak to Sanjay Pugalia about the latest situation in Jammu and Kashmir. First offering from the Shapoorji Pallonji's main business vertical, the Mumbai headquartered group is looking to list its solar EPC arm called Sterling and Wilson Solar. The IPO will be the largest equity primary offering this year. Samit Sarkar is here with the details. Samit, how big the IPO is? What does the company do? Are there any notes which are saying they should subscribe or not subscribe?
Well, I'll start off with the company size first. Now, the company is looking to raise close to 3,125 crore rupees from the initial public offering, which opens today and closes on 8th August. The price band for this IPO is set at 775 to 780. 2020. Now, post-listing, the promoter holding on this company would come down to 75% because it is a pure offer for sale, that 3,125 crore rupees, and both the promoter and the chairman of the company will be selling their stake, and their stake in the company would come down to 75%. Now, at the upper end of the price band, that is 780 rupees per share, the total market capitalization of the company on listing would be close to 12,500 crore rupees. So what is Sterling and Wilson Solar? Where it is a pure play end-to-end solar EPC solution provider. Now, in 2018, it was the largest player in globally, and it also provides operation and maintenance services, but currently the contribution of this segment to the total revenue is close to only 1%, and they're looking to ramp up this segment. So this will be one of the important segments that the company would focus going forward. Now, the company has presence in nearly 26 countries, and it has so far commissioned nearly 205 solar EPC projects with a total capacity of close to 6,870 megawatts. Now, the company's total order book stands at close to 3,830 crore rupees as of 31st March 2019, and so far it has received letter of intents worth nearly 3,900 crore rupees, which takes the total order book of the company to close to 8,000 crore rupees. Also, its order book is fairly diversified. As you can see here, it gets nearly 26% of its orders from US, 22% from Europe, while the rest of it comes from Southeast Asia, Middle East and North Africa, and the other parts of Africa. Now, also, if you see the company's revenue, now it is also diversified. It gets nearly 70% of its revenue from foreign markets, with Middle East and North Africa contributing nearly 48% to the company's total revenue. From India, the company gets nearly 30% of its revenue as of financial year 2019.
What about the financials of the company, Sumit?
So if you see the company's revenue and net profit, now they grew at a CAGR of nearly 44% and 72% over FY16 to FY19. Now, the growth in revenue was primarily driven due to the significant increase in EPC revenues coming in from Southeast Asia, Africa, United States of America, and because of Europe. Now, the company's EBITDA, now that increased at a CAGR of 50% over FY16 to FY19, and its EBITDA margin averaged at around 6.5% over FY16 to FY19. But over that period, it has increased to nearly 7.8% in FY19. That is because of the operational efficiencies and the operating leverage that the company has derived from higher revenues that it has been clocking. Now, if you see the company's debt as of FY19, the total debt of the company increased to close to 2,200 crore rupees, but that was because of an intercorporate loan given to a promoter group company, and its leverage as of FY19, its total debt to equity stood at close to 2.6 times and total debt to EBITDA at close to 3.5 times. However, this would come down to zero because the promoter group has promised to repay the amount within 90 days of listing. So this total debt of 2,200 crore rupees will move out of the company's book, and it will be a debt-free company post 90 days of listing. Now, it works in an asset-light business model, because of which if you see the company's return ratios, they are very high. The return on equity is nearly 76%, return on capital employed is close to 121%, and return on asset is 12.4% as of FY19. Now, on the peer side, the company does not have any domestic listed peer, and according to the company, on the global side also, there's no other company which has a global presence like them in the global market. And on the valuation side, if you see the company's EPS as of FY19 was close to 40 rupees per share, and its price to earnings for FY19 comes at around 19.6 times. Its market capitalization to sales at 1.5 times, and its enterprise value to EBITDA at close to 22.4 times. Now, only one brokerage note has come out with a subscribe rating for this IPO, that was Prabhudas Lilladher, and they have a subscribe rating because of a cheaper valuation. As you can see, the price to earnings is just 19.6 times. Given the strong growth opportunity and its execution capabilities, the company, the brokerage has a subscribe rating for this IPO.
Okay, well, let's wait and watch how it does. It's a large IPO, and therefore maybe the subscription numbers, even if it's very attractive, will not be as much as Affle India, for example. But let's wait and watch. Let's not preempt that. Good company. Sumit's given the details. Sumit, thanks so much for putting all of that into perspective. The world's largest solar EPC contractor. Remember, the world's largest, not just India's largest. Okay, the next piece on First Word. Consumer staple makers clock in a softer growth in the June quarter. The demand slowdown plaguing the economy is reflecting on the consumer sector earnings as well, but surprisingly, they have been able to expand margins. Agam Pugalia is standing by to compare and contrast the numbers. Agam, were you surprised as well that the margins have been expanded? Typically, these companies would pull their belts tight in tough times.
Yeah, absolutely. And that's actually worked out in favor of them, pulling their belts tight up in tough times. But let's talk about the slowdown, because that is clearly the big takeaway here. And that's the slowdown is not only evident, and many analysts would have expected numbers to remain very similar to what we were used to in the fourth quarter, but the numbers have actually worsened. So as you can see, almost for all the companies except for Nestle and Dabur, we've actually seen growth temper even further for this particular quarter. That is the first quarter of FY20. And on an average, well, we've actually seen, the growth rate come off from well over 7% to 5.8% if I just consider these handful of companies in the FMCG sector. Do remember, for this particular study, I've considered only companies with a market capitalization of over 30,000 crores. And of course, Britannia and as well as Procter & Gamble's are yet to announce their earnings. But moving on, this is very evident in the volumes too. And as you can see, the volumes numbers for almost all the companies have come off, fallen. The only exception again for this particular quarter is Dabur because of, it's clearly surprising the street with that 9.6% volumes growth. So what is it that's actually working against volumes and revenues growth for this particular quarter? Well, first and foremost, there is less cash in the hands of consumers amid that economic slowdown. We do have persistent liquidity issues in wholesale and retail trade channels. And of course, this is also largely to do with a slowdown in consumption. And of course, rural growth, which has been a key driver, has also seen deceleration. So these are the various reasons behind which we are seeing that temperance in revenue growth as well. But margins, of course, it was a saving grace for this particular quarter, and all companies, and here there are no exceptions, we've actually seen growth and expansion in EBITDA margins. So let's take a look at as to why this EBITDA margin expansion has come through for a whole host of these companies. Of course, the likes of Marico will have that advantage of copra playing out. But besides that, we do have in general a benign raw material or input cost environment, which is aiding gross margins and thereby operating margins. But operating margins have also been given a leg up because of aggressive internal savings and a lot of cost optimization that the companies have been bringing out. And of course, because of the fact that the demand hasn't been that great, we've also seen lower advertising and promotional spends, which have also kept margins in check for the quarter. But finally, what's going on? What's the outlook here? So, consumption slowdown, according to Mahesh Nandurkar, is not that steep yet, based on his observations in some of the FMCG companies. We also know that companies like HUL, Marico, or Dabur, for that matter, are suggesting that the second half of the financial year is likely to see a little bit of an uptick as per their expectations, and that could, of course, improve things for them. And of course, companies are hopeful that the liquidity situation, not only in trade channels but also in the hands of consumers, could improve going forward should there be some government intervention, which is what they are hopeful of, and that could of course aid demand. But again, none of this is evident in any of the numbers yet, so it's going to be a wait and watch according to a lot of analysts out there.
Okay, Agam, thanks a lot. Thanks for putting that into perspective. Well, that's with regards to the FMCG names, staples in particular, and how they've done this quarter. Now to the big news. The Rajya Sabha has passed the Jammu and Kashmir reorganization bill that divides the state into two union territories, J&K with a state legislature and Ladakh without one. It also votes to adopt a statutory resolution that recommends the president abrogate or modify Article 370 of the Indian Constitution. Remember, it's Article 370 that gives J&K its special autonomous status and does not give it some benefits that accrue to the rest of the states. To discuss these amendments, its legality and politics, we are joined by Sanjay Pugalia, editorial director at Quintillion Media. Sanjay sir, good morning. Thanks for joining in. Before I ask my two questions, throwing this open to you, now you've had the benefit of the last, 12 hours maybe, to try and digest all that's happened, look at the responses from Amit Shah and the parliament as well. What has stood out for you?
This is a humongous move, and now India will tread in a unknown territory in terms of what happens in the future. The message is clear that now Jammu Kashmir becomes a union territory, not even a regular state. Forget about the special powers or special status that it enjoyed. So now we are in an absolutely new phase. We do not know what Kashmiris think, because the way Indian state has moved to manage the situation, where we have no idea what is going to be their reaction. Mainstream Kashmiri leaders have been totally delegitimized by various pronouncements by the BJP there.
And we will have to wait for the new voice and the new leadership to emerge. I think the game plan of Delhi would be to hold an election after this big action and then get a new assembly. That will also, they will try to, that it ratifies the changes that has been made. And then it will get a total validation. What happens in terms of development there, we have heard big promises. I hope they are implemented because that will help manage the public mood there in a better manner. Otherwise, now this new situation is fraught with many risks. We do not know how Kashmiris are going to react, and that is the space we have to watch.
Sanjay, when I happened to hear Amit Shah's response late evening as well, amongst a lot of other things. And because you look at the business side and the economic side so well, my question to you, he pointed out a lot of factors which may have been coincidental or which may have been a factor of J&K doing what it has done in the last 70 years. You know, land prices not moving up, business opportunities not quite there, the quantum of money that center has consistently sent to J&K not being seen on the ground, etc., etc. If you have any thoughts there of whether or not, even if those were valid, a move like this can help change some of that, an economic benefit coming to the state because of a move like yesterday?
In principle, that has always been an idea that the moment we create economic opportunities in the state, so these young Kashmiris, after the loss of 2 generations in alienation, will not throw stones and they will start working. They want to be with India. They aspire to move around the country without any fear, and they want their own Kashmir to prosper. But yeah, one agrees that in last 70 years, all such efforts have not really given us a great result. But there are some misnomers that one can't set up a business there or buy a land. There are processes. There are many Indian companies that are operating there. There are many chain of hotels. They are operating in Kashmir and they are doing quite well. But yeah, the entire Kashmir has been in a way locked down since last many decades. So once you open up, you can allow business opportunities to flourish, and government can really move in a major manner and create big economic opportunities. No doubt about that.
Okay. One last political question, because the economic benefits, as you also said, would be visible, I guess, over a period of time and not really immediately. Difficult to predict that. My question is, do you think from a political viewpoint, from an optics perspective, has the Modi government timed this right?
I would think so, from the perspective of what Trump was trying to do with Pakistan. He was trying to give more legitimacy to Pakistan because America needs Pakistan's help because it wants to get out of Afghanistan. China is also aligned in this whole process. So for India, on this particular issue, was standing alone, and India needed to make sure that Pakistan doesn't have any lever in the Kashmir game. So to throw them away or to delegitimize their intervention, this whole idea of integrating Kashmir in more deeper manner with the Indian state will work as a protection shield. And I think timing is important from that point of view. I do not think many people talk about that is it a distraction from the real economic crisis? No, this has been BJP and RSS a long cherished dream that this is how Kashmir stories should be written for the future. That's what they have done. And in the second term, if you see on the core issues that BJP has promised, they are trying to move faster. As far as economic issues are concerned, that has always been a track two agenda for them. They will address that as and when they are free from other things.
You trust Sanjay Pugalia to tell it, to call a spade as is, and the most important part of that conversation in the answer that you heard right now. Thanks so much, Sanjay, for joining me today and giving us your perspective.
Thank you.
That's all that we have on First Word today. Lots more lined up on Indian Open, though. We discuss markets and macros with Tahir Badshah of Invesco Mutual Fund. Very important to talk to him about what to do with the broader markets. Take a look at how telecom companies performed in the June quarter with Rajiv Sharma of SBI Cap Securities. And more importantly, will Indian metal firms continue to suffer as global tensions keep prices subdued? Paul Bartholomew of S&P Global Platts and Amit Dixit of Edelweiss join in that conversation. After this break, a full tilt towards the day's trade.